looking for accurate context, good risk management, and always exercising good patience.
Anytime you're talking about fundamentals in a market and direction, fundamentals take a little bit of time to play out.
We got crude oil today, kind of trading yesterday's value area really nicely, low to high.
That's what we're here for, is to put ourselves in the best success. A trading routine does that, builds that habit, lets you know what to work on, what to reflect on, and what to improve on the next day.
Hello, everybody. Welcome to Coach's Playbook on Tuesday, January 18th, not teeth. You ask, we listen. We're listening to the feedback, and you guys want some more examples, some more visual stuff? Well, we're giving it to you today, but we're talking about gaps, and Hogue is going to instruct us on this. But first, Mick, you got a shout out for us?
I do. Big shout out to Sean Miller this morning, up about $1,400 trading the NASDAQ. So, and it's actually his first day today. So that's an awesome start to the funded account.
First day. I take it he's short. It's a hell of a day we're having on the NASDAQ, hell of a week. That's something I'm looking at going forward for sure. But as you're looking to trade it, perhaps you want to use a little bit of the mojo given to us by Hogue. And Hogue, you suggested today that we talk about gaps. And I was wondering if when we put this visual up, you can kind of walk through what the hell we're looking at and why it's something you should be paying attention to here.
Of course. In the market forecast and personal performance coaching, group performance coaching, even in some of the, we haven't really gotten there yet as far as the foundations are concerned. There's always a lot of people asking, what is a gap? How what does it mean? How can we take advantage of gaps as far as looking for opportunities? And, I know we've talked about gaps a little bit in the past, and I thought it would be probably a good idea to revisit them because they do offer a context to the marketplace. They offer and an opportunity. I know that we've got a screen share that we're going to put up, and this is going to be representative of a daily gap. There's really two different kinds of gaps. There's a weekend gap, which prior to electronic trading, all gaps looked like weekend gaps. There were holes in the charts where there was no trading, and then trading would resume. But even with electronic trading, with 23-hour long trading, gaps are really important to be aware of and to use to your advantage because they do offer, again, some context and some opportunity in the daytime frame as well as in the future. Got a good example of one as soon as we're ready to put that up, and unless somebody else wants to go talk about them.
Well, we got it up.
We got it up. Okay. So Hogue, talk us through it. It looks like my first thing I'm looking at here, looks like we got a natural gas chart.
Yes.
All right. From January.
Yes.
Where we are right now.
Yeah. So if you watch the market forecast, you're gonna see that I kind of encapsulate time in extended trading hours and then regular trading hours. You can see that the volume profiles, there's a little bit of a kind of a shadow around them, and those are showing us what is happening in the regular trading hours. Natural gas, I look at about 8 o'clock till about 1:30 as far as regular trading hours are concerned. So you can see, the price is moving along that lower black line there. That's one of the weekly kickoff lines. And then there's a day that kind of breaks out above that. And then there's a continuation that's inside that shaded box. Okay. That's something that is occurring outside of regular trading activity. Then the market opens the following day, leaving the gap. And then you can see what happens that day. The price continues to push higher and higher throughout the day. On the very next day, you see price coming down off the high that was put in on the 19th or the 18th, I think that was. And then price comes down and just fills in that gap that was left a couple of days prior, almost to the tick. So you can see when we leave a gap and we can't close that gap relatively early, and we can talk about what relatively early means. Everything is subjective in futures trading, but if the market leaves a gap from the previous day, that's a sign of excess. What is excess? Price either was viewed as too cheap during that period of time or too expensive. In this case, when this gap was created, that excess was left as too cheap because price continued above it. The following day, price was something changed, and that gap was now viewed as actually fair value on the following day. It's kind of hard not to have the cursor on there, but you see value high and value low on the 14th, I believe that is basically the high and low of the gap. The area that was viewed as too cheap the prior day became value the day after that. So when we do have gaps, there's, well, just about anything can and will happen. But when you have a gap, there's a basic rule that says if we can't close the gap relatively early. What is relatively early? Again, that's a subjective term. This particular gap, there was almost no effort to close it in the regular trading hours. That gives us the idea that something has changed, and that with no attempt to close that gap, the market is likely to continue in that direction. So unclosed gaps, we trade in the direction of the gap. In that case, we would trade to the long side. If a gap is, as if there's an attempted gap close, we try and stay patient. We can either try and catch the gap close, or we can stay patient and look for better trade locations after the gap is closed, if it is. Sometimes the market or price will come down and will attempt to close the gap, but doesn't quite fill the gap. That is important information as well. What doesn't happen is sometimes is equal to or more important to what does happen. So when you have the opportunity to work in and around a gap, it allows you or affords you some relatively basic rules with which to trade with. The difficult part is what is closing the gap in a reasonable amount of time.
Okay, well, I will get Dan and Mick involved here, and whoever raises their hand first, if you have any insights on that or questions for Hogue about trading around the gap here.
I was just going to add kind of another way I'll look at it too, right? Because so gaps can be looked at. There's a ton of different gaps is used in a lot of different ways in trading too. I think if you guys watched the recap prior to this whole thing, COVID, I don't know if you heard about it, but where it sent us all working from home. John and I used to jokingly say every day, please mind the gap. As the market opened up away from a settlement price, right? Because there's still a gap to close that gap to prior day settlement price. There's a lot of different ways of looking at gaps. And truthfully, for me, one of the biggest things to keep in mind when you're looking at this is you want to wait and see if the market starts to make the attempt. If it's not making that attempt, you have to kind of pull it away from that repertoire. You've got to move on. But if the market starts to make the attempt towards the gap and then possibly filling that gap, that's when your chances are there to execute. So it's just one of the tools in your toolbox to be able to look at some of this stuff. Don't bank on it just because there was a daily gap like that. But if the market starts to make those rotations towards it, that's when you can start to look for a chance. Secondly, you want to start to show some acceptance inside. So we saw that prime example, which was a great example of it. You saw the market opened up away from the gap. Now, as the market starts kind of coming into that gap, it broke down a little bit more. And as it approached, the first thing you have two options as that a market's approaching that gap. You can say, hey, we might get a really nice bounce here and we might see this market recover. So you can take that trade. Pretty simple trade. Risk is relatively managed. You want to see that bounce happen kind of nicely. Once that market starts trading inside and we start to see a little bit of acceptance, that's when the short side trade is available. It's not as soon as the market approaches, but you want to see that market get inside. And a lot of times you may miss the initial short, and your chance is then waiting for it to get to the low side of that gap, because then that's where you can execute again. So there's a lot that goes on to hopping into this. So like when you do see these gaps, and John is pretty darn good at making sure he has them in all the forecasts, market forecasts, where he's pointing them out to you. As the market is coming down to that gap, don't just jump in right away and say, oh, here comes the breakout, I'm selling this to the downside. Let that market get inside. Let it actually prove to you it's going to hold within there. Every market will be a little bit different. If you were listening to the Limit Up podcast last Thursday, Jack and I talked about this idea of elasticity, right? So some markets say it's the NASDAQ has a gap like that. The NASDAQ may hit that level, move through it really nicely originally, and it can snap right back on you because it's got this elasticity. That level's still holding, even though we've traded below it, it can snap right back up on you. So just some cautionary things to think about as you're trading these gaps.
Yeah. So now we had a natural gas chart up here for the example. Do you think that this is something that you look at more? Obviously, you look at it in every product, but do you think this is something that is more of a viable strategy in something like natural gas or crops or things that are more traded during these sessions? Or is this something you're looking at with the stock indices, like the S&P 500, for instance, where there's more activity overnight?
Definitely
Personally,
something I look at through all of the markets. You know, if there's one thing that each market, no matter what the underlying commodity is, has in common, they are just a part of a never-ending auction process, and the auction process allows, you know, similar situations, similar setups, if you will, similar strategies. I was going to use the S&Ps. There's a gap that we're looking to close today. I don't remember if we quite filled it yet, but you know, there's an opening gap between yesterday and today. There's a gap that was left in the past that sometimes those become magnets, and you can come and expect the market to at some point go and recheck those levels. The thing about gaps is, you know, everything has to be taken in context. You know, if you've got a market that recently bottomed and it was too short, and then you get a gap up to the next, or you get a gap higher the next day, you know, that's a market that has shown evidence of changing. There's maybe a less of a probability of the gap closing. So you look probably a little bit earlier to start looking in the direction of the gap or looking for longs. You know, there's situations where you'll get a blow off top one day in the morning. And, you know, in a market that is, you know, moving to the downside, you'll get a big up move overnight. And that's going to be probably one of those trades that you're more likely going to fill the gap. You know, one of the things about gaps is you're also considering overnight inventory. The position of the overnight traders that moved price away from the previous day's range is something that you have to consider. Are there going to be weaker hands? Are they in the direction of the bigger market, or are they contrary to the bigger hands or the bigger market? Always something to be considering when you're thinking about this, but the basics are true. If you can't close that gap relatively early, there's a good probability price will continue to move in that direction.
I would just add to that too. There are some products you got to be cautious about, right? You got something like crude oil opens up at 8 o'clock technically, but you see huge volume a lot of times coming in through that London session. The euro or some of those currencies, you see them bring in some really strong overnight volume, that those gaps on something like that, a daily gap like that, is not going to be as, I think, strong as something like, for me, S&P is a big one. I love the equity gaps. I think those are important because you see a drastic change in volume at that 8:30 open versus what you saw at 1 a.m.
One
Yeah,
more
you see
thing,
those. Oh, please.
the bigger the gap, the less likely it is to fill.
Yeah. And this is something that you have to consider too, presumably, if there's any, as we'd say in economics, exogenous things that happen there, right? If it's a gap because some huge geopolitical event happened, you know, probably not smart to be playing around with these things. I think this is more something in the day to day. Like you don't want to be trying to, COVID's an example, remember in that March
Sure.
where it's hammering down. That shouldn't be your prime concern there. Mick, do you have any
Everything we've done in
questions or
text.
gap thoughts? Talking gaps.
No questions at the moment. I really like what John and Danny were saying. As far as, gaps, in my opinion, to me, they're a reference point. They're an area of importance similar to a previous day's high or low or a previous week's high or low. It's just an area I want to be conscious of on the charts. Nowadays, with all the trading being done electronically and basically 23-hour trading sessions, it's a very different environment than it was, prior to electronic trading. My background being in the grains, grains opened at 9:30 a.m. and they closed at 1:15 p.m. Central Time. It was a 3-hour and 45-minute session where there was no trading that happened after, the close at 1:15 until the following morning at 9:30. So you could have new information coming into the markets that participants couldn't even act upon when that information came out, which usually would cause, a higher open or a lower open the following day. I do not personally use these for my own reasoning behind taking a trade. However, it's a reference that I want to be aware of. I was always coached and told from, day one that, gaps tend to close themselves. You need to be very careful whether or not you're taking trades, the following day of a gap or the same day of a gap, because I've noticed in my experience that gaps do tend to get closed, but it doesn't have to be, that following day, that following week. It could happen many, many months in the future. I do like what Danny was saying as far as, trying to trade around a gap for, taking profits. You could see a market gap higher one day, and then later on the week, it starts trading lower towards the upper end of that gap area. And, you might find resistance at the top of that gap area. So you don't want to necessarily go, try and make a short trade before we dive into that gap and start filling it in, thinking that you can buy it at the lower end. A lot of times, these markets like to test previous day's high and previous day's low, previous week's high, previous week's low, just like they like to test these gap areas. So, if you are going to use a strategy intraday for filling these gaps, I would suggest, like Danny said, make sure we're actually inside the gap, that we're not, testing it. We've dipped into those levels and maybe you can scoop up a couple ticks here or there on a trade. What I've noticed in my own observations, the longer you go prior to filling a gap, longer you go with a gap that's left unfilled, could be the quicker that you actually fill the gap too. So that's something to keep in mind. These, to me, gaps are just a reference point. They're important. You think about what happens to the participants when we do have gaps. If there's over the weekend, I think back to it was probably a couple of years ago, we had some news out that there was an oil refinery that was bombed. And I remember crude oil had gapped up that Sunday evening, $6 plus. And you have to think about, what happens to the short participants when there's a $6 gap. We're talking 600 plus ticks. Shorts are going to be puking trades. They're going to be accelerating, the market getting goosed to the upside because they have to get out of those trades. Also, at the same time, you're going to have people that were long that are now, looking to add aggressively to profitable positions. So it just further accelerates the market. So there can be a lot of interesting activity to take in when this stuff's happening. My best suggestion for, what does a gap mean to you? Go back, look at gaps, watch them as they're unfolding, as we're trading around those levels, and start to make your own observations and see, oh, this happened this time, this happened this time. How could I use this for the next time? And, see if we're always looking to profit on things. So see if you can make any observations that would allow you to do so.
Yeah, I think that's some good insight there, Mick, as far as the gaps go. Hogue, is there anything you'd like to add to this today before we move on? I think it's just as Mick laid it out there. You got to be cognizant of the overall market, but it's important to know where these things are, and it's a great opportunity to take advantage of if you know what you're doing and know when to get out, essentially. So Hogue, with one of those, say in that natural gas, say you took, obviously we can't because we see where the chart goes eventually, but
Right,
say when
right.
it's trying to fill that gap, you do get short there. When are you getting out of that trade? So say it establishes in the range, starts going against you. Are you waiting till it gets established outside the range again to the upside, say on the natural gas, or?
Are you talking about inside the gap or acceptance inside the gap?
Yeah, so it gets into the gap, starts establish itself in there. You go short. It goes again in that natural gas example because it was closing
Sure.
at, you'd be short. Starts going against you. Where are you looking to get out? Do you wait till it gets outside that range, or are you
Yeah, like Dan was saying, if you get a market that leaves a gap and then comes back and starts to accept back inside the gap, it's from above into the gap. If you start to accept the top end of the gap is really likely to become resistant, and so I'll try and get in as close to that level as possible with a stop just outside. I don't risk a lot. When I see a level and I see an opportunity, I'm looking for that opportunity to provide me a little bit of risk and greater reward. So as far as number of ticks, it depends on the size of the gap. It depends on the size of the marketplace. But one of the things that Mick said, and if you don't use gaps for opportunities, knowing where they are is of course important because they do get revisited. The one thing I've learned about markets is they are extremely visual. If you don't keep those gaps in some way, shape, or form on your charts, you're never going to know when they're being targeted. Because when traders are looking for a level or looking at a level, they're driving price towards that level.
Good to know. Well, Hogue, Mick's got something here. I can see it.
I just want to add one other thing for our traders out there. Most charts default to the 24-hour session charts. You on any platform, you'll have the ability to single out pit session only, or you can customize your own time frames and plug in the old pit session trading hours where you can find that information.
That's good to know.
Mhm.
All right. Well, Hogue, thank you for running us through this today. And Dan and Mick for adding those insights. And Dan, do you have a little something to inspire the people today?
I do. I got come from Mark Douglas. If you can learn to create a state of mind that is not affected by the market's behavior, the struggle will cease to exist. I don't know if it'll cease to exist, but the struggle will get a little bit easier.
Yeah, it's a little easier. There's always going to be struggles out there, but hopefully you're not struggling out here on this cold Tuesday in the upper Midwest, but hope you're having a good time. Hope you're trading well. And in the meantime, we'll see you next week on Coach's Playbook. That's all for now. Bye, y'all.